I'm always happy to run a set of numbers, tell you what I'm seeing, tell you if there's any red flags from our perspective. Getting that feedback from your syndicator, from your lender early can save you a lot of time.
Welcome to BuzzHouse, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrick Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. In the affordable housing industry, the state of the low-income housing tax credit equity market is always top of mind. Obviously, one of the most popular panels at many conferences. We have gone through a lot in the industry through the last couple of years with the COVID pandemic, and as of late, of course, the bank failures. So it seems like there's so many macroeconomic factors around the LIHTC industry. To talk to some of these points, among other discussion items, we're excited to have Rachel Rhodes, who I've had the pleasure of knowing for a good number of years, a managing director at the National Equity Fund, or otherwise known as NEF. With a lot of topics to cover, we want to jump right into our discussion with Rachel, and I'm going to turn over to Garrick. Garrick?
Thanks, Don. And Rachel, welcome to the show. So to begin, Rachel, would you please tell us a little bit about your role as managing director of the Central Region for NEF, along with a little bit about NEF as an organization?
Sure, absolutely. And thanks for having me on, guys. This is a real pleasure, so I appreciate the invitation. So National Equity Fund, as Don said, we are a national, as the name might imply, tax credit syndicator. We're a 501c4 nonprofit organization. We've been doing this for 36 years now. We've invested over $23 billion in 48 states, so been around for a bit. My role for the last just over a decade, I guess, has been to lead the Central Region originations efforts for NEF. Central Region changes a little bit year to year in terms of what states we include, but generally it means, well, my good friends in New York and LA call the flyover states, and I call the best places to live, the center of the country. And our team is responsible for working with developers, maintaining those relationships, finding the best deals for NEF to invest in. And then, of course, working with our partners here at NEF and our investor relations group and our project management group to find the right investor, get them closed, then working with our asset management folks to sort of oversee them for the next 15 years. I will say this can be a BuzzHouse exclusive. My role right now is managing director of the Central Region. I think by the time this episode is released, my role will actually have changed. I'm going to be taking on oversight of our overall LIHTC production nationally. So,
wow, congratulations.
Yeah, but don't ask me anything about the coasts yet. I haven't learned it. So,
oh, that's exciting, Rachel. Good. Congratulations.
Thanks.
Yeah, congratulations on that, Rachel. And it's good to hear. And diving into our actual questions, there are a lot of things that are affecting us nationally and actually globally. You can turn on any news station, you'll hear about the current topics of the Silicon Valley bank shutdown. So in your opinion, how does this Silicon Valley bank shutdown actually affect low-income housing tax credit industry in the macro level? And how does it affect the developer looking to get an equity letter of interest today in today's market?
Not gonna lie, we were all panicked for like a week there. Bank failures, never a good thing. Bank failures among one of our favorite investors. I mean, we did a lot of work with Silicon Valley Bank. They were great to work with. And the initial panic was, well, wait a minute, like I've got a construction loan draw that I submitted yesterday. What's gonna happen? Or from our perspective, we've closed on an equity transaction, but we made our closing installment. They're committed to the completion and stabilization installment. What's going to happen? And we were all just sort of waiting to hear. Thank you, FDIC. They stepped in, they stabilized. We've now got First Citizens stepping in to buy them, and that's wonderful. So the good news is that everything is stable. Any closed transaction, those obligations are being met. Big sigh of relief. The next sort of phase of it then is, well, what happens? I mean, this leaves a hole, obviously, in the sort of investor world for California as well as for Boston. SVB had a relatively new presence in Boston. It's yet to be determined who's going to step in to fill that vacuum, what that's going to mean for pricing and equity placement in those specific markets. I don't worry too much in general. We went through this in 2008, 2009. We saw banks failing and consolidating, and it was sort of a short-term, obvious issue, but long-term, we always rebound. There are always financial institutions that really want to be in the LIHTC space. This is a great asset. So long-term, I don't think there's going to be any dramatic impact. I think in the sort of near term, in those particular markets, again, fewer investor dollars as we stabilize. There's also sort of a macro impact when banks get into trouble, especially for things like, hey, your credit oversight wasn't strong enough. It does tend to mean that all banks everywhere get a little more credit focused, right? So I think we will see a little bit in the market overall of banks being a little more cautious. And when banks are a little more cautious, that means syndicators are a little more cautious, and it will be on the lending and on the equity side. Your relationship manager people at the banks are going to be getting a lot of pressure from on high to make sure that their investments are sound. And I think there's probably going to be a little bit of upward pressure on yield requirements as well. You know, part of the SVB failure was their investments weren't yielding high enough based on where current interest rates are. I think we'll see a little bit of a push there on the CRA side of things. I will also put a little plug in here. This is one of the reasons to have a syndicator and not go direct. If your bank fails, your syndicator is still there for you. We've got other bank investors. We'll figure it out. If you're direct with a bank, you're in a much different position. I'm just saying.
Thank you for that, Rachel. No, a great overview, too, of many components. Rachel, kind of skipping to a little bit of a underwriting type question. I mean, interest rates have been on the top of everyone's mind for the last 12 months and the rises and even like, you know, thinking about construction, sizing your construction, interest reserve and your development budget. You know, is there any tricks to that? What are you doing with that? And maybe just a quick follow-up to that is, has underwriting changed at all over the last 3 years, the COVID pandemic and where we are today?
The interest reserve sizing really more than anything is being led by the construction lenders right now, and they're being very conservative. So we had the unfortunate issue of the deals that closed sort of in the first half of 2022, sizing their interest reserves based on a 3.5% interest rate during construction. When that rate ended up at 7.5%, we have a lot of deals right now where they are very much underwater on their interest reserves, and banks are seeing that on existing deals. And so the effect is the construction lenders are really requiring more of a cushion on the interest rate itself when sizing the reserve, but also more of a cushion on the time horizon that they want to size to. So if you're saying, okay, I've got a 14-month construction period, your lender may say, I want that reserve sized at 18 months or 20 months, because again, we've seen so many construction delays due to supply chain issues. Nobody can get a transformer anywhere in the country, and that's pushing things out. And the banks really need to be able to show their credit people that there is enough there or running stress scenario after stress scenario. So that really is being led much more by the lender side, and the lenders are so conservative that works just fine for us. Overall, we are doing a lot more stressing in general. For things like delays. There's been a lot of, every deal that I do when I present it to my review committee, I have to do the stress scenario of what happens if we're 3 months delayed, what happens if we're 6 months delayed, what's the impact to all of these things, the ongoing interest carry, what will the adjusters be, et cetera, and is there enough cushion in the deal to provide for that? That isn't helped by the fact that we're seeing higher deferred developer fees in deals as everybody gets squeezed. That's, of course, where it comes in. So it's a matter of making sure that our deferred developer fee isn't too high. We like to try to keep it under 50% if we can. That's getting harder and harder to do. But if it's more than 50% deferred, you're going to see higher percentages of that paid fee held back until stabilization to make sure, because that's our cushion for all things.
Switching gears, a lot of maybe even newer developers, but even developers have been out there a long time, here, economic investors versus CRA. And, you did mention previously some upward pressure on yields and things like that. Could you kind of maybe talk about It seems like we've seen some pretty big spreads right now between economic and CRA, maybe just what you're seeing in the market.
Yeah, absolutely. The spreads are huge right now. An economic investor, if there's really no CRA play, is going to be looking for a yield in excess of 7%, generally 7.5%. And as interest rates climb, that obviously climbs. The CRA investors, it really depends on the market, right? CRA, there are the very, very, very heavy CRA needs, and then it shrinks as the number of deposits in any given market does. So it's anywhere from, in the hottest markets, I think we're still 3.75 or 4, but there are a lot of markets that were at a 4% last year that now I need to be at a 5 or even a 5.25. So that really has inched up, and I think that's going to continue to inch up a little bit. And again, the economic is, even for the 5.5%, which is sort of the highest of the CRA investors, an economic is 200 basis points above that. Just to translate for developers listening in, general rule of thumb, not always the case, but general rule of thumb, 25 basis points equals a penny. So if you want to think of that in pricing terms, 200 basis points is going to be 8 cents. It's real.
That is a real number. And we actually work a lot with developers. We're always running through these scenarios, et cetera. One of the big things that we're always talking about, because obviously we want to be cognizant of involving investors or syndicators at the time to get the best information to them, so we're not going back and forth a lot. So a lot of questions we get is, what is the best time for a developer to actually talk to you about a potential project they're working on? Is it before an application for tax credits, or maybe after it's submitted, or even after they've received an actual award?
My strong suggestion is early and often, early and often. The earlier that I know you've got a deal that you're thinking about, even if, hey, I don't even have a pro forma that works yet. I don't know if this is going to turn into an application, but if I know you're working in a deal in a certain area, I can make a note of that. That can go in my system. And then as we're talking to investors out there, and I get an investor coming in saying, hey, we really want something in X county. Do you know of anything out there? If I know about that deal early, I can be lining up those dollars early. And again, that can be the difference between the 5.5% investor who happens to need just $8 million in that county versus the 7.5% investor, which is my only other option. So there's that. There's also I'm always happy to run a set of numbers, tell you what I'm seeing, tell you if there's any red flags from our perspective. Getting that feedback from your syndicator, from your lender early can save you a lot of time. You spend a lot of time putting a deal together, structuring it, and then you put it out you get your credits, you put it out for bid, and everybody comes back and says, well, I can't do that deal. Well, now what are you supposed to do, right? I'm happy to give feedback early. And then also keep me posted as it moves forward. Are you actually applying or not? Should I keep this on a list or not? I had a developer yesterday say, hey, this is the one we looked at last year. It's basically the same deal, except we figured out we can get $1 million in home funds, so here's how we changed it. Still doesn't have a credit award, still nothing for me to do with it in terms of like an actual equity bid right now, but it's really useful to me to hear about the changes as they're happening, to be updating my numbers, updating my system. That allows me to move faster. Once you do have that credit award, it helps to get bids out faster.
Those are great points, especially where you're talking about the different investors and what they're looking for. That's definitely, I guess, a reason for many why they should start early.
Yeah, and it changes every day, right? Literally week to week, I'm getting updates from investors saying, I know I said I was full here, but this deal died. Unfortunately, we're seeing deals really struggle right now. And so sometimes people think that they have their needs met and they don't. You want me to know that you've got a deal there so I can pull it if I need it.
Don will attest to this. There's a lot of deals changing. And then the good thing is soft financing comes available and all of a sudden the deal's viable. So point well taken. Moving on, what would be a BuzzHouse if we're not talking about the IRA, right? So we've been having a lot of discussions about the Inflation Reduction Act, and we're obviously working on a lot of LIHTC transactions. They're considering some of this solar and other items that come along with that. So has NEF been looking at this, and will you be able to underwrite that into sort of the deal up front or treat it as an adjuster? So we won't necessarily know what solar tax percentages a deal will have until later, right? Because all this information is coming out. But what's your take on that?
The majority of our investors can absolutely take the solar credit. We've bought solar credits even pre-IRA. It was just, they weren't of as much value. You had to take them out of basis, et cetera, et cetera. But we definitely did deals with solar credits and continue to do so. And they obviously are more valuable now than they were before. We have a couple of investors that can't take them. The GSEs can't take solar credits. But for the most part, our bank investors, it's a very, very easy credit for them to take, right? It's immediate. There's no real question on it. The question, as you say, is, okay, but what's the credit amount? Because I don't know what percentage to apply. So the answer on that is we can certainly underwrite upfront to a 30% energy credit. That's fine. If we think that maybe this is one that might be at 50, can we underwrite to that upfront? Maybe, and that's going to be a matter of who's the developer, what does that balance sheet look like, what does the overall deal look like in terms of cushion. This is a small amount of a capital stack. I mean, it's more valuable now than it was, but it's still relatively small as compared to the rest of your sources. So sometimes it's a matter of, all right, the difference between 30 and 50% is $70,000. We'll underwrite to that so that you've got it in up front, but we know that, again, there's enough developer fee there that if it doesn't materialize, that just is a downward adjuster. Sometimes it goes the other way, and we're going to underwrite upfront to the 30% and an upward adjuster if you end up getting a higher percentage.
Very good. Well, that's very helpful. I think, Rachel, as Garrick said, almost every deal we're looking at is contemplating that.
Yeah, there's really no reason not to. Most states have enough energy requirements that you're going to qualify for something, and you may as well use it. It's a little bit of gravy, and every single penny counts right now.
Exactly. One last question for you here today. We obviously talked about a lot of equity issues, and maybe just going back to NEF as an organization, I know you've got maybe some debt products or anything you can kind of tell us about some of those products in general, or what type of transaction would those be used for?
Yeah, absolutely. So NEF at its core is a LIHTC syndicator. We have for many years now, in association with that, had pre-development loan funds available. So if you're going to syndicate with NEF, we have a lovely pre-development loan program. We are happy to do pre-development loans. Come to me to ask about specific terms, but those are pretty easy. And then in the last few years, we've really been expanding our overall other lending options. Our mission is to finance affordable housing in as many ways as we can. So we have what is now a pretty stable and impressive preservation loan program, which preservation for us means it's generally like a 3 to 5 year term. The idea is you're going to go buy an existing property, buy a GP interest. Maybe you're going to do a HUD refi on it, or you're going to do an eventual LIHTC syndication. The seller needs their cash in the next 60 days, and a LIHTC execution or a HUD execution is going to take a little longer than that. So that's been a great program for us. Again, very favorable terms. Done a lot of lending under that across the country. We have a nascent and quickly growing workforce housing lending and investment platform. The initial offshoot was our preservation loans and the idea of, okay, well, you can buy a NOAA property and it doesn't necessarily have to be a 60% AMI limit. It could be 100% AMI limit, and we can do the same thing here. So we have funds available for that, and we're working as we speak on figuring out the new construction side of that as well. You know, workforce housing is many of our LIHTC developers are doing that already. It's such an important, that missing middle piece that we all talk about all the time. We really want to make sure that we're getting dollars into that space. The other interesting thing that we've done recently is we are now partnered with CPC Mortgage Company in order to provide permanent financing, both agency debt and FHA debt. Again, we have a lot of lender partners who we adore, many of whom are our investors, many of whom we've just been working with for years. I am happy to do equity and have one of them do the perm loan, but if there is a need for permanent loans, either on a LIHTC deal or on a non-LIHTC affordable or workforce deal, we have the ability to do that as well.
Very good. I think that'll be great information for a lot of our listeners. So that's it for this episode of BuzzHouse. A big thanks to Rachel Rhodes of National Equity Fund for joining the show today to give us feedback on a number of matters here around the LIHTC equity market and just a little bit more about National Equity Fund as an organization. Thank you very much, Rachel.
Thanks so much. This was great.
Very good. Once again, I'm Don Bernards.
And I'm Garrick Gibson. Don't forget to subscribe so you don't miss an episode. For additional resources around multifamily housing, check out bakertilly.com. If you have a suggestion for the show, email us at bild@bakertilly.com. That's BUILD at bakertilly.com. See you next time on BuzzHouse.